The silence is officially over. On January 30th, 2026, regulators moved in on a Chicago bank, took control, and ended the fantasy that the banking crisis was contained. One Friday afternoon, the doors closed. By Monday morning, the sign was changing and the message was clear. The lag effect isn't coming later. It's here now, and it's hitting hard. For months, the financial world has tried to gaslight everyone into a sleepwalk. They told you the system was stable. They told you the fires of 2023 and 2024 were out. They pointed at a quiet headline cycle and said, "See, everything's fine." But here's how it really works. Think of the banking sector like a house. For the last 6 months, the fire alarm stopped ringing. People assumed the fire was out. But the truth is, the fire just moved inside the walls where you couldn't see it. Now the smoke is pouring out. And this bank failure is your proof. Metropolitan Capital Bank and Trust didn't randomly close. This was the first domino of 2026, the first bank to fail in the nation this year. And it tells you something uncomfortable. Distress doesn't vanish. It goes underground until it breaks through the surface. If you have money in a bank right now, you're living inside a system that runs on confidence, speed, and math. And when the math turns against the bank, it doesn't get a dramatic countdown. It gets a Friday night shutdown and a Monday morning rebrand. If you want to see how I'm navigating this market personally, I built the 100X Club. It's where I drop exclusive weekly videos breaking down the exact stocks I'm buying, plus access to the Millionaire Blueprint, the full framework I use to think like a long-term investor. It's all in the pinned comment. All right, back to what just happened in Chicago because this collapse is a warning shot. At the time of closing, Metropolitan Capital Bank and Trust had roughly $261 million in assets. And I already know what some people are thinking. That's small. That's nothing compared to SVB or the mega banks. Wrong mindset. This isn't about the size of the boat, it's about the hole in the hull. In banking, a small crack in the dam can flood the entire valley. Because it's not the one bank that matters, it's what that bank represents. Pressure building inside the system, especially for small and mid-sized banks that don't have infinite access to capital, infinite liquidity, and infinite patience from depositors. Here's exactly what went down. The Illinois state regulator closed the bank late Friday, and the FDIC stepped in as receiver. That's the government firing management, taking the keys and locking the doors because unsafe and unowned conditions is regulator language for. The bank's position is broken and it can't continue. And to stop panic, they executed the standard playbook, a purchase and assumption deal. Overnight, the FDIC struck a deal with First Independence Bank out of Detroit to assume substantially all deposits and buy most of the assets. That's how they keep the streets calm. That's how they keep you from seeing the smoke while the firefighters are still inside. So, if you were a depositor, you woke up and your debit card still worked. Checks still cleared. Direct deposits kept coming. The branch reopens under new ownership like nothing happened. But if you owned equity in the holding company or you're an unsecured creditor, you already know what that means. Zero. That equity evaporates the moment the papers are signed. In banking, you don't get a slow exit. You get wiped. And the official explanation again was unsafe and unsound conditions and an impaired capital position. Translation in plain English, the bank's cushion got crushed. Once the capital is impaired, the game ends. Now, let's talk about why this keeps happening. Because this is the part people miss. Metropolitan was a commercial bank. It served small and medium businesses in Illinois. And those borrowers, the real economy, the businesses that employ people and rent space and run payroll, those borrowers are the ones getting squeezed by higher rates, higher costs, and slowing demand. This is the vice. On one side, the bank is holding loans written in a low-rate world. Old loans, cheap loans, loans that pay the bank pennies. On the other side, depositors can now demand higher yields. They can move money instantly. One click, one tap. Deposit flight is frictionless, so the bank's cost of funds rises fast, while the income on the asset side rises slowly, if it rises at all. That's how margins collapse. And when borrowers start struggling, when delinquencies rise, when a few big commercial credits wobble, those losses hit capital directly. When the cushion gets thin enough, regulators don't negotiate with vibes. They close the place. Now, zoom out because this failure didn't happen in a vacuum. It broke a quiet streak. There were two bank failures in 2025, Pulaski Savings Bank in Chicago on January 17th, 2025, and the Santana National Bank in Texas on June 27th, 2025. Then the headlines went quiet for the second half of the year. People got comfortable. And now, right out of the gate, 2026 opens with a bank getting shut down in Chicago. January 2025. January 2026. That pattern matters, not because months are magic, but because it shows you how this system behaves. Losses don't always show up when the market is loud. They show up when the calendar turns and reality catches up to the balance sheet. And yes, there's a localized angle here. Illinois has now seen multiple bank failures across the last couple years. That should make you pay attention to regional concentrations, local commercial real estate stress, and smaller institutions with less diversified exposure. But do not make the mistake of thinking this is just a Chicago problem. That's dangerous. The same poison that kills one small bank is flowing through the veins of thousands of banks across America. Duration mismatch, deposit competition, commercial real estate risk, and the brutal math of refinancing in a high-rate world. Metropolitan didn't die suddenly. It bled out slowly, quietly, digitally. And that's the new killer in 2026. Because people still imagine a bank run like it's 1930. Lines outside the door, people screaming, cameras flashing. That's history. A bank run now is silent, invisible. It happens while someone is eating dinner and scrolling. It's a few taps, a transfer, a sweep into a money market fund, a move to a mega bank. Millions of clicks, billions of dollars, and small banks can't survive that speed because their assets are not liquid. Their loans are not instantly sellable at full value. Their bond portfolios may be underwater. Their cash is finite. So once the outflow starts, the clock is ticking. Now, let's talk about the cleanup bill because that's the part people wave away. The FDIC's early estimate is that this failure will cost the Deposit Insurance Fund about $19.7 million. And the official line is always this doesn't cost taxpayers a dime. Technically, the FDIC fund is financed by assessments on banks. But don't be naive about how the real world works. When banks pay higher assessments, higher premiums, higher regulatory costs, do they just eat it? No, they pass it on. Higher fees, lower yields on your savings, tighter lending, more friction, less generosity. In the end, the consumer pays for system stress, whether it's through higher prices, worse terms, or fewer options. Now, look at the chessboard. First, Independence Bank stepped in and bought what it wanted. This is the strong eating the weak. It's consolidation in real time. It's bigger institutions absorbing smaller ones, often at discounts, often with government-managed transitions. And that raises the most important question of the entire story. How many more weak banks are out there right now? Because there is a list, not a public list, not a list you can pull up on your lunch break. Regulators keep a confidential problem bank watch list. You don't get to see the names. I don't get to see the names. The public sees the bodies after the fact, after the doors are locked. So we have to read signals. We have to read the environment. We have to understand what kind of disease kills banks in this cycle so you can recognize the symptoms before the headline hits. And here's the part that should make every sharp observer sit up. Regulators are moving faster now. They're not waiting for a crowd outside the branch. They're not waiting for a viral panic. They're moving in on a Friday, closing the institution, transferring deposits, and reopening under new ownership before Monday business hours. They do it to keep you calm. They do it to maintain the illusion of stability. But the very fact they're doing it this cleanly and aggressively tells you the system is under stress because they're trying to prevent psychology from turning a manageable failure into a contagious stampede. And if you want to understand what's lurking behind these closures, you have to look at the usual suspect commercial real estate. This is the toxic asset of 2026. Office towers, shopping centers, mixed-use buildings, construction loans, refinancing cliffs. For decades, commercial real estate lending was boring. It was safe, predictable, collateralized. Then the world changed. Post-pandemic work patterns changed demand for office space. Retail got reshaped. Cap rates moved. Financing costs exploded. And suddenly, a building that was worth under $0 million on paper isn't worth $100 million in the real world anymore. Here's how that destroys a bank. A bank lends $10 million against a building. 3 years later, the building's cash flow is weaker, the vacancy is higher, and its market value is down. Now, the borrower has to refinance, but the new rate is higher and the new appraisal is lower. The math doesn't work. So, the borrower hands over the keys, or the loan becomes impaired, or it becomes a pretend performing loan because the bank doesn't want to take the loss. That's the game. Extend and pretend. And for a while, banks can play that game. They can restructure, they can delay, they can patch, but eventually loans mature. Reality arrives and the refinancing gap becomes a wall. This is why 2026 matters so much, because the lag effect is real. High interest rates don't hit instantly like a punch. They hit like a slow poison. The economy absorbs it, adapts for a while, then 18 to 24 months later, something snaps. That's the window we're in. And that's why you're going to hear more routine closures that aren't routine at all. Now let's talk about something people get wrong. The idea that only bad banks fail. Metropolitan Capital Bank and Trust opened in 2005. It survived 2008. It survived the housing crisis. It survived the pandemic era. But it couldn't survive this rate environment and this refinancing cycle. That should tell you how brutal the grinder is right now. Because it's not just rookies getting taken out. It's the math taking out anyone who got caught with the wrong assets, the wrong funding mix, or the wrong exposure at the wrong time. And there's another quiet killer here. Capital markets have alternatives. Why would an investor recapitalize a struggling small bank? Take equity risk, headline risk, regulatory risk, when they can earn strong yields in treasuries and high-quality money markets. That's what a capital strike looks like. When fresh capital stops showing up, the bank can't absorb losses. It can't rebuild buffers. It can't restore confidence. And once depositors sniff that weakness, the outflow accelerates, which means the failure isn't always caused by one bad loan. It's caused by a system where confidence can vanish faster than a balance sheet can heal. Now let's get practical, because this is where people get lulled into false security. A lot of viewers hear FDIC and think, cool, I'm safe. And yes, FDIC insurance is real, up to the limit. But two things matter. One, the insurance limit has rules. Ownership categories matter. Account structure matters. If you don't understand how your accounts are titled, you may not be as covered as you think. Two, even if your deposits are covered, disruptions still happen. Systems get transferred. New routing numbers, new processes. Temporary holds can happen in edge cases. Business accounts can get complicated. And if you're running payroll with balances above the insurance limit, you're not playing the same game as someone with a $3,000 checking account. In 2023, the government chose to protect depositors in extraordinary ways. People now assume that will always happen. But will Washington do that for every small bank in 2026? That's a gamble. Politics matters, optics matter, fatigue matters. Officially, the rule is the rule. The limit is the limit. So if you're a business owner or you keep large balances parked in one place, you have to think like a risk manager, not like a spectator. And here's the bigger picture that should keep you focused. We are entering a period of forced consolidation. Small banks will keep getting eaten. Main Street will keep losing local lenders. And when local lenders disappear, the local economy loses something people don't appreciate until it's gone. Relationship credit, handshake, understanding, local knowledge, the ability for someone to look you in the eye and say, I know your business, I'll work with you. Replace that with a distant algorithm and suddenly credit availability becomes a spreadsheet decision made hundreds of miles away. That's how a banking crisis turns into a credit crunch. And credit crunches don't stay in the banking sector. They hit construction, retail, manufacturing, hiring. They hit payrolls, they hit confidence, they hit the real economy. In fact, one of the cleanest ways to watch stress build is to watch lending standards. When banks tighten, they demand higher credit scores, stronger collateral, better terms. They don't want risk, they want safety. And when banks want safety at the same time, the economy loses oxygen. That's the vacuum effect. One bank failure doesn't just remove one bank, it removes a lender from the ecosystem permanently. And when enough lenders pull back, even healthy businesses get denied. Projects get canceled, expansion plans die, hiring freezes start, layoffs follow, and that's how financial stress becomes a recession for normal people. Now, let's talk about scale because this is where the tsunami analogy comes in. Commercial real estate has a maturity wall coming. A massive amount of CRA debt is scheduled to mature by the end of 2027. Trillions of dollars in refinancing needs. That means borrowers who financed at low rates are going to face today's rates, and many properties won't support the new payment. That gap has to be filled by new equity, lower valuations, or defaults. There is no magic fourth option. And who holds a lot of that exposure? Smaller and regional banks, just like Metropolitan. That's why this matters. Metropolitan's $261 million in assets is small, but it's a symptom of a much larger disease. And the disease isn't just commercial real estate. It's the combination of higher rates, lower valuations, refinancing cliffs, and deposit competition. That combo is lethal. Now, here's the most dangerous part of this entire story. It's not the loss of capital, it's the loss of liquidity. Liquidity is oxygen in banking, and in 2026, oxygen can vanish in minutes. That's why regulators are acting like ninjas, because they're trying to stay ahead of the speed of fear. And fear is contagious. Banking runs on confidence. Confidence is the only currency that matters. If you believe your money is safe, the bank survives. If you doubt it, the bank can die fast, even if it looks fine on paper. Every time you see another closure headline, confidence chips away for someone else somewhere. And that psychological erosion changes behavior. People save more, spend less, hoard cash, pull back, and that alone can turn a slowdown into something uglier. Behavioral contagion is real. Now, earlier I mentioned there's a specific signal I watch that lights up before a bank fails. And I'm going to be honest with you. I've analyzed the balance sheets of major regional banks, and there are institutions flashing warning signs right now. I'm not talking about a vague feeling. I'm talking about identifiable stress markers, concentrations, funding profiles, asset liability mismatches, and exposures that don't tolerate another shock. And one of those banks could be where you keep your money. That's why you need to stay locked in, because the next domino will not come with a siren. It will come with a Friday press release. Now, let's bring this full circle because this is what Metropolitan Capital really represents. It represents the end of the easy money era. It represents the beginning of creative destruction in banking. It represents a system being forced to tell the truth about asset values, especially in commercial real estate. And it represents the path we're on. More consolidation, fewer community institutions, and more power concentrated in the hands of the megabanks. That's the direction of travel. And here's the paradox that should worry you. The more the system consolidates, the more fragile it becomes at the top. Because if you shrink the number of important banks, you increase the consequences when a truly large one stumbles. The safety net can catch small failures, but it can't catch everything. That's why the goal of regulators right now is a controlled demolition. Blow up the weakest without shaking the skyscraper. But controlled demolitions go wrong when the explosives are stronger than expected, and the explosives in this cycle are refinancing stress, CRA valuation resets, and digital speed deposit flight. Now, let me give you the realistic takeaway without sugarcoating it. This is a time for defense. It's not the season to chase returns blindly. It's not the season to assume it can't happen here. It's the season to be smart about concentration risk. If you keep balances far above FDIC insurance limits in one institution, you're making a bit whether you realize it or not. If you rely on one local lender for your business lifeline, you're exposed to a system that can pull the plug over a weekend. And if you think a bank run looks like a line outside a branch, you're living in the past. In 2026, a bank run is a smartphone. So yes, diversify where you keep liquidity. Understand your insurance coverage, avoid needless concentration, and stop assuming quiet means safe. Quiet just means the fire is inside the walls and we just saw smoke.